There's a bank that's so powerful, its former employees run central banks, treasury departments, and entire governments around the world. They've been accused of causing financial crises, manipulating markets, and controlling economies. Yet somehow, they always survive, always profit, always win. Goldman Sachs isn't just a bank. It's a machine that creates billionaires, topples governments, and shapes the global economy. They bet against the housing market in 2008 while telling clients to buy, then walked away with billions while the world burned. They've been called a great vampire squid, wrapped around the face of humanity. Their alumni include treasury secretaries, central bank governors, presidents, and prime ministers. Today, we're going inside the most powerful and secretive financial institution on earth. This is the story of how Goldman Sachs became the bank that literally runs the world. And trust me, it's way more disturbing than you think. Let's go back to 1869. A German immigrant named Marcus Goldman arrives in Philadelphia with basically nothing. He works as a door-to-door salesman selling hats. It's hard work, and he barely makes enough to survive. But Marcus is observant. He notices that small business owners have a problem. They need short-term loans to buy inventory or pay workers, but banks won't lend to them. The amounts are too small. The risk is too high. Traditional banks only want to deal with big, established companies. Marcus sees an opportunity. He moves to New York and sets up a tiny office in the basement of a building next to a coal chute. His entire office is basically a closet. But from this closet, Marcus starts buying IOUs from small merchants at a discount. A merchant needs $100 today, but will have the money in 30 days. Marcus gives them $98 cash right now in exchange for the promise of $100 in a month. The merchant gets the cash they need immediately. Marcus makes $2 profit. It's called commercial paper, and Marcus becomes one of the first people in America doing this business. For the first 10 years, it's just Marcus walking around New York with IOUs literally stuffed in his hat. When he needs to cash them, he takes them to established banks who trust his judgment. It's a tiny operation, but Marcus is building relationships and a reputation for being trustworthy and smart. In 1882, he invites his son-in-law, Samuel Sachs, to join the business. They rename it Goldman Sachs. Still just two guys in a basement, but they're starting to handle bigger transactions for bigger clients. By the 1890s, Goldman Sachs is growing. They're not just dealing in commercial paper anymore. They're helping companies raise money by issuing stocks and bonds. This is called investment banking, and it's way more profitable than commercial paper. In 1906, Goldman Sachs helps take Sears Roebuck public, which is a huge deal. Sears was like the Amazon of its day. Being the bank that took them public gave Goldman Sachs serious credibility. Over the next few decades, Goldman Sachs becomes one of the most respected names on Wall Street. They're smaller than giants like J.P. Morgan, but they have a reputation for being smart, discreet, and good at making money. They survived the Great Depression when many banks collapsed. They help finance America's industrial expansion. They're making their partners very rich. but they're still relatively unknown outside of finance circles. Then comes Sidney Weinberg. In 1907, a 16-year-old kid from a poor Brooklyn family drops out of school and takes a job as a janitor's assistant at Goldman Sachs. His job is literally emptying trash cans and cleaning bathrooms. But Sidney is ambitious and smart. He watches the bankers work. He teaches himself about finance. He starts getting opportunities to do small tasks. He works his way up slowly over decades. By 1930, Sidney Weinberg becomes the senior partner of Goldman Sachs. A former janitor is now running one of Wall Street's most prestigious banks. Sidney transforms Goldman Sachs. He builds relationships with corporate CEOs across America. He becomes the banker that major corporations trust with their biggest deals. Ford Motor Company, General Electric, Sears, Continental Can. They all use Goldman Sachs because Sidney Weinberg knows everyone and everyone trusts him. He also establishes a culture at Goldman that will define the firm for decades. He preaches teamwork over individual glory. He talks about being long-term greedy, meaning you don't screw clients for short-term profit because you want their business forever. And he hires the smartest people he can find, often from elite universities, and works them like dogs. By the 1950s and 60s, Goldman Sachs is one of the top investment banks in America. They're advising on the biggest mergers and acquisitions. They're taking major companies public. They're making their partners incredibly wealthy. But they're still a private partnership, not a public company. This means they don't have to disclose much about what they're doing. The secrecy becomes part of their mystique. Then in the 1970s and 80s, Wall Street changes dramatically. Banks start trading for their own accounts, not just for clients. They start creating complex financial instruments. They start taking bigger risks, and they start making insane amounts of money. Goldman Sachs embraces this new era aggressively. They build a massive trading operation. They hire mathematicians and physicists to create sophisticated trading models. They start making more money from trading than from traditional investment banking. In 1981, to Goldman traders named Gus Levy and John Weinberg, Sidney's son, pushed the firm into something called risk arbitrage. This is basically betting on whether mergers and acquisitions will happen. If Goldman hears that Company A might buy Company B, they'll buy Company B's stock before the deal is announced, then sell it for a profit when the stock jumps after the announcement. It's legal, but it requires inside knowledge and quick action. Goldman gets very good at it, very profitable, but also very controversial. The 1980s are also when Goldman's alumni start moving into government positions. In 1985, Bob Rubin joins Goldman Sachs and eventually becomes one of the top partners. In 1995, he leaves to become Treasury Secretary under President Bill Clinton. This is huge. The Treasury Secretary controls America's economic policy. Having a former Goldman partner in that role means Goldman has unprecedented access and influence, and Rubin is just the first. Over the coming decades, dozens of Goldman executives will move into top government positions around the world. In 1999, Goldman Sachs goes public. For 130 years, they'd been a private partnership. Partners shared profits and losses. Going public meant selling shares to outside investors. Many long-time partners were against it. They worried it would change the culture. They were right to worry, but the money was too tempting. When Goldman went public, it created hundreds of millionaires overnight. Partners who had been paid well, but not astronomically, suddenly had wealth beyond imagination. The IPO also gave Goldman access to massive amounts of capital to expand their trading operations. And expand they did. Through the 2000s, Goldman became increasingly focused on trading. They were betting on currencies, commodities, stocks, bonds, derivatives, everything. They were using enormous leverage, meaning they were borrowing money to make even bigger bets. When their bets won, the profits were staggering. In 2006, Goldman's revenue was over $37 billion. Their profit was $9.5 billion. For one company, that's more profit than most major corporations make in revenue. But the real story of Goldman's power and ruthlessness comes from what they did leading up to and during the 2008 financial crisis. This is where things get dark. In the early 2000s, Goldman Sachs was heavily involved in the mortgage-backed securities business. Remember from the Lehman Brothers story, banks were giving mortgages to anyone with a pulse, then bundling those mortgages into securities and selling them to investors. Goldman was one of the biggest players in this market. They were creating these securities, selling them to clients, and making huge fees. But by 2006, some people inside Goldman started getting worried. The housing market looked like a bubble. Too many bad loans. Prices going up too fast. It couldn't last. A trader named Josh Birnbaum started betting that the mortgage market would collapse. He was shorting mortgage-backed securities, meaning he was betting their value would drop. At first, his bosses told him to stop, but the head of Goldman's mortgage department, a guy named Dan Sparks, and others started to agree with him. In late 2006 and early 2007, Goldman made a huge strategic decision. They decided to flip from being long on mortgages to being short. They started betting against the very securities they had been creating and selling to clients. They bought credit default swaps, which were basically insurance policies that paid off if mortgage-backed securities failed. They were preparing for a collapse. Here's where it gets ethically horrifying. While Goldman was internally betting billions that the mortgage market would crash, they were still creating mortgage-backed securities and selling them to clients. In fact, they ramped up their production of these securities in 2007. They created a particularly toxic security called Timberwolf, which was backed by some of the worst mortgages you could find. Goldman's own people called it she***y in internal emails. Yet they sold it to clients, telling them it was a good investment. One Goldman salesperson wrote in an email, "Boy, that Timberwolf was one she***y deal." Another wrote about a different deal. "The whole building is about to collapse anytime now." These weren't rogue employees. This was company policy. Create securities, sell them to clients, bet against them, profit when they fail. When the housing market did collapse in 2007 and 2008, Goldman's bets paid off spectacularly. while other banks like Lehman Brothers and Bear Stearns were imploding. Goldman made billions. In 2007, when the market was crashing, Goldman's profit was still $11 billion. They'd positioned themselves perfectly. Their clients, the people who bought the securities Goldman sold them, lost everything. Pension funds, insurance companies, foreign banks, they all got destroyed. But Goldman won. Then came September 2008 and the complete meltdown of the financial system. Lehman Brothers collapsed. AIG was ours. From bankruptcy, the entire system was freezing up, and even Goldman Sachs, with all their smart positioning, was suddenly in danger. Why? Because they had enormous exposure to AIG. Goldman had bought billions in credit default swaps from AIG as insurance on their positions. If AIG went bankrupt, those insurance policies would be worthless, and Goldman would face massive losses. This is where Goldman's political connections became crucial. Remember Treasury Secretary Henry Paulson, the guy who decided not to bail out Lehman Brothers? He was the former CEO of Goldman Sachs. He'd left Goldman in 2006 to become Treasury Secretary. Now, in September 2008, he was making decisions about which banks to save and which to let die. The conflict of interest was staggering. When AIG was collapsing, Paulson orchestrated a government bailout. The Federal Reserve gave AIG $85 billion, which eventually grew to $182 billion. Why? Officially, because AIG's failure would destroy the financial system. But here's the thing. A huge portion of that bailout money immediately flowed from AIG to the banks that had bought insurance from them. Goldman Sachs received $12.9 billion from the AIG bailout. They got paid in full, 100 cents on the dollar, for their credit default swaps. No losses, no haircuts, full payment, courtesy of American taxpayers. Other banks got paid too, but Goldman got the most. And they got it because their former CEO was the Treasury Secretary making the decisions. Paulson later claimed he recused himself from decisions directly involving Goldman. But he was the guy running the entire bailout operation. His fingerprints were all over it. The optics were terrible. Average Americans were losing their homes and jobs. But Goldman Sachs, after helping create the crisis by selling toxic securities, was getting bailed out and staying profitable. In 2008, as the economy collapsed, Goldman still made $2.3 billion in profit. In 2009, they made $13.4 billion. They set aside $16.2 billion for employee compensation and bonuses that year. For perspective, that's about $500,000 per employee on average. The public was furious. People were protesting in the streets. The Occupy Wall Street movement was born from rage at banks like Goldman. Rolling Stone magazine published an article by Matt Taibbi calling Goldman Sachs great vampire squid wrapped around the face of humanity, relentlessly jamming its blood funnel into anything that smells like money. The article went viral. It captured what millions of people felt, that Goldman was corrupt, predatory, and protected by their political connections. But Goldman survived. More than survived. They thrived. In 2010, the securities, An exchange commission charged Goldman with fraud related to how they marketed those mortgage-backed securities. The SEC said Goldman had created securities designed to fail and didn't tell investors that a hedge fund was betting against them. Goldman settled for $550 million without admitting wrongdoing. That sounds like a lot, but it was basically a parking ticket for a company that had made billions from the same activities. No Goldman executives went to jail. Nobody was criminally prosecuted. Lloyd Blankfein, who was CEO during the crisis, kept his job until 2018 and left with hundreds of millions of dollars in wealth. The company paid some fines, made some settlements, and moved on. The system had protected them. And here's the disturbing part. The revolving door between Goldman and government didn't slow down after the crisis. It accelerated. Bob Rubin, the former Treasury Secretary, had been replaced by Larry Summers. Another guy closed to Wall Street. Then came Tim Geithner, who became Treasury Secretary in 2009. While not a Goldman employee, Geithner was president of the New York Federal Reserve during the crisis and had worked closely with Goldman on the bailouts. In 2013, Mario Draghi, a former Goldman Sachs vice chairman, became president of the European Central Bank, controlling monetary policy for the entire Eurozone. In 2017, Gary Cohn, president of Goldman Sachs, became the director of the National Economic Council under President Trump, basically running economic policy. Stephen Mnuchin, another Goldman alum, became Treasury Secretary. The list goes on and on. Goldman people are everywhere in positions of power. This creates an insidious problem. When the people regulating banks used to work for Goldman and might work for Goldman again after government service, can they really regulate aggressively? When the people making economic policy are from Goldman, are they making decisions that benefit the country or benefit Goldman? The conflicts of interest are obvious and troubling. Goldman's defenders argue that Goldman hires the smartest people in finance. So, of course, governments want those people. That Goldman alumni understand markets and can navigate crises. That their success isn't from corruption, but from being better than competitors. And there's some truth to that. Goldman does hire incredibly smart people. Their training program is intense. Working at Goldman means 100-hour weeks and brutal pressure, but also learning from the best. But the pattern is undeniable. Goldman is involved in nearly every major financial controversy and crisis. Yet they always emerge unscathed or even stronger. Let's look at some examples beyond 2008. In the 1990s, Goldman helped the Greek government hide the true extent of their debt using complex derivatives. This allowed Greece to join the Eurozone despite not meeting the financial requirements. When the truth came out in 2009, it triggered the European debt crisis. Greece nearly went bankrupt. The European economy was damaged for years. Goldman made hundreds of millions in fees for helping create the problem. In 2011, Goldman was accused of betting against a Libyan investment fund's portfolio while advising them. Libya had invested $1.3 billion with Goldman. Within months, 98% of it was lost. Goldman claimed it was just bad luck and market conditions. Libya claimed Goldman had intentionally created trades designed to fail. It went to arbitration and was eventually settled, but the accusation fit a pattern. Goldman has a history of creating investments for clients, while simultaneously betting against those same investments. Goldman has also been repeatedly accused of manipulating commodity markets. In 2008, when oil prices spiked to $147 per barrel, causing pain for consumers worldwide, Goldman was one of the major players driving speculation in oil futures. In 2011, they were accused of manipulating aluminum prices by controlling warehouse supplies through their ownership of Metro International Trade Services. By moving aluminum between warehouses, they could delay delivery and drive up prices. This cost consumers billions. Goldman eventually sold the warehouse business, but made a fortune first. The company has also been involved in multiple countries' corruption scandals. The most egregious was in Malaysia with the 1MDB scandal. Between 2009 and 2015, billions of dollars were stolen from One Malaysia Development Berhad, a Malaysian government fund. Goldman Sachs helped 1MDB raise $6.5 billion through bond offerings and made $600 million in fees. That's about 10 times the normal fee rate. Why? Because Goldman bankers knew the deals were shady. Money from these bonds was stolen by Malaysian officials and used to buy yachts, art, real estate, and even fund the movie The Wolf of Wall Street. When the scandal broke, Goldman paid $5 billion in settlements to the US and Malaysia. Two Goldman bankers were criminally charged, though one remains a fugitive. But the company itself faced no criminal charges. So how does Goldman always get away with it? How do they survive every scandal, every crisis, every investigation? The answer is a combination of factors that create an almost impenetrable shield. First, they're genuinely good at what they do. Goldman hires the smartest graduates from the best schools. They pay them incredibly well. The average Goldman employee made over $100,000 in 2021. Managing directors make millions. Partners make tens of millions. This attracts top talent, and that talent creates real value for clients. Even if the methods are sometimes questionable, companies want Goldman advising on mergers because Goldman has the best bankers. Investors want Goldman managing their money because Goldman has the best traders. The skill level is real. Second, they have information advantages. Goldman has thousands of clients across industries and countries. They see deal flow that nobody else sees. They know what companies are planning before it's public. They know what governments are thinking. This information isn't always insider information in the illegal sense, but it's incredibly valuable. They call it market intelligence. Critics call it an unfair advantage. Either way, it lets Goldman see around corners that others can't. Third, they're everywhere. Goldman has offices in dozens of countries. They do business in every major market. This geographic reach means they can shift activities to wherever regulations are loosed. If the US cracks down on something, they can do it in London or Singapore instead. They can structure deals through subsidiaries in different countries to minimize oversight. The complexity of their global operations makes them very hard to regulate effectively. Fourth, they're too big and too connected to fail. During the 2008 crisis, regulators were terrified of letting Goldman collapse because they knew it would trigger a chain reaction. Goldman had trading relationships with thousands of other financial institutions. If Goldman went down, it would take many others with it. This too big to fail status is a form of protection. The government can't let them die without risking systemic collapse. Goldman knows this, and it affects their risk-taking. Fifth, and most importantly, they own the referees. Not literally, but through the revolving door between Goldman and government. When Goldman alumni are running treasury departments and central banks, regulations tend to be written in ways that don't hurt Goldman too badly. Enforcement tends to focus on fines rather than criminal charges. Bailouts get structured to protect Goldman's interests. It's not always explicit corruption. Often it's just people protecting the institution they came from and might return to. But the effect is the same. Goldman gets special treatment. This combination of factors creates a company that's essentially above the law. They can take enormous risks because they know they'll be bailed out if it goes wrong. They can push ethical boundaries because they know the penalties will be manageable. They can influence policy because they have former employees in positions of power. It's a perfect system. If you're Goldman Sachs, it's a nightmare if you're anyone else. The culture inside Goldman reinforces this. Employees are taught that Goldman is special, that they're the smartest people in finance, that the rules that apply to others don't really apply to them. There's an arrogance that comes from decades of success. Former employees describe an environment where making money justifies almost anything, where client relationships matter only as long as they're profitable, where the firm's interests always come first. There's also intense pressure to produce. Goldman's famous up or out culture means if you're not getting promoted, you're getting fired. The average analyst lasts to 2-3 years before burning out or getting cut. Even at senior levels, partners who have a bad year can be forced out. This creates an environment where people will do almost anything to make their numbers. Ethics becomes secondary to survival. But it works. Goldman has been the most profitable investment bank in the world for most of the past 20 years. Their return on equity, meaning how much profit they generate from their capital, has consistently been among the highest in banking. They have higher profit margins than competitors. They attract the best clients and biggest deals. By traditional business metrics, Goldman Sachs is one of the most successful companies ever created. The question is whether that success is good for society. Goldman would argue yes. They provide capital to companies that create jobs. They make markets more efficient. They help pension funds and endowments grow their money. They facilitate global trade and investment. All of that is true, but the costs are real too. They helped cause the 2008 crisis. That destroyed trillions in wealth and millions of jobs. They've manipulated markets that affect everyday people's lives. They've corrupted governments and enabled corruption. They've created inequality by extracting wealth from the real economy into financial markets. Today, Goldman Sachs is worth about $130 billion. They have over 45,000 employees worldwide. They made over $60 billion in revenue in 2023. They continue to dominate investment banking, trading, and asset management. And they continue to place their alumni in positions of power across the world. The current Treasury Secretary, Janet Yellen, isn't from Goldman, but the pattern continues elsewhere. Former Goldman executives run major corporations, sit on boards, control hedge funds and private equity firms. The Goldman network is vast and influential. When you meet someone who worked at Goldman, they'll often drop it into conversation quickly. It's a badge of honor, a signal that they're part of an elite club. And that's really what Goldman Sachs is. It's not just a bank. It's a network, a system, a way that power and money circulate among a very small group of people. You go to the right schools. You get hired by Goldman. You work insane hours and learn how financial markets really work. You make a fortune. Then you rotate into government or major corporations or start your own fund. And you maintain your Goldman connections because those connections are valuable. You help each other. You protect each other. And together, you effectively run the global financial system. Is this a conspiracy? Not in the traditional sense. There's no secret meetings or explicit coordination. But there doesn't need to be. When all the key players come from the same institution, went to the same schools, worked for the same company, and share the same worldview, they naturally make decisions that benefit their group. They're not trying to hurt everyone else. They genuinely believe that what's good for Goldman and Wall Street is good for the world. But they're wrong, or at least, the evidence suggests they're wrong. The financial system Goldman helped create is enormously profitable for Goldman, but increasingly disconnected from the real economy. Financial sector profits have grown much faster than the overall economy. Wall Street compensation has exploded while middle-class wages stagnated. More and more of the economy's gains flow to financial firms while ordinary people struggle. This isn't sustainable. Eventually, something breaks. Goldman survived 2008, but the next crisis might be different. Public anger at Wall Street has only grown. Political movements on both the left and right are targeting big banks. Regulations have gotten tougher. Though Goldman adapts, the question isn't whether there will be another financial crisis. There will be. The question is whether Goldman will survive the next one, or whether the political will to protect them will finally run out. What can we learn from the Goldman Sachs story? First, conflicts of interest matter. When the same people rotate between regulating banks and working for banks, the regulations will favor banks. We need real separation between Wall Street and Washington. But nobody in power has the incentive to create it. Second, culture matters. Goldman's culture of aggressive profit-seeking created real harm. When making money becomes the only value, ethics disappear. Third, complexity is dangerous. Goldman's operations are so complex that regulators can't fully understand them. This complexity is often intentional, creating opacity that allows questionable practices. Fourth, incentives drive behavior. When Goldman employees are paid based on short-term profits, they'll take actions that maximize short-term profits regardless of long-term consequences. The compensation structure on Wall Street encourages excessive risk-taking and short-term thinking. And finally, power corrupts. Goldman has so much power and so many advantages that they operate under different rules than everyone else. No institution should have that much influence over the global economy. The Goldman Sachs story isn't over. They continue to shape the world economy. They continue to profit from every boom and survive every bust. They continue to place their people in positions of power. The vampire squid, as Matt Taibbi called them, continues to feed. And unless something fundamental changes in how we regulate financial institutions and separate money from political power, Goldman Sachs will keep winning. They'll keep surviving every crisis. They'll keep running the world. Because that's what they've always done. And they're very, very good at it. The next time markets crash, watch your profits, and you'll understand who really has power.